before cost segregation, there's depreciation. So depreciation is essentially tax law that you buy a property. I can use flat numbers. Let's do buy a big commercial property for $1 million. All right, you take land out of the equation. Land is non-depreciable. You know, if a tornado came and knocked a building down, what's left?
The land.
The land. If you are buying a property and selling it in the same year, you don't need cost segregation.
Yeah, but
you don't even need depreciation in that case.
Yeah, but that's very unlikely.
Because something important to mention is that when you sell that property, the depreciation come back. Because that was a surprise for me in a bad way. but
I want to talk about that once we completely fully understand the concept and how it applies. Okay, so that's one chance you don't need it. If you're having losses with other properties, you wouldn't need it either.
Yeah, I mean it's a whole calculation play. If you have enough losses with all your other properties to offset that one for maybe this year and next year, you don't do cost seg.
Hola, hola, ¿qué tal? Estamos en un episodio más de Real Estate Talks. Gracias por escucharnos. ¿Cómo estás, Lala?
Hola, Gaby. Pues aquí súper contenta de estar aquí el día de hoy contigo otra vez. Tenemos un gran invitado, a Brian Bigham. Hola, Brian.
Hola.
La verdad es que el tema del que vamos a hablar hoy, que es el cost segregation, es un tema súper interesante y no hay mucha gente que sepa del tema y aquí tenemos a un experto. Va a ser un podcast en inglés. Pero pues encantados de aclararles lo que sea. No, lo bueno que hoy con ella es muy fácil hacer las traducciones, ¿no?
Claro.
Para el que no le agarre tanto el inglés.
Claro, claro que sí. Thank you, Brian, for being here today.
Thanks for having me.
I love that topic. It's fascinating to me. But before we start talking about that, tell us a little bit about yourself.
About myself.
How do you start in the real estate world?
If you can't tell, I'm a giant, But now I've been in real estate for almost 20 years. But the whole concept of real estate to me was just buy properties, make income, pay the government, and do it again, wash and repeat. But about 7-8 years ago, I discovered what cost segregation was.
Before that, let me go back. So you started as a real estate investor, full-time, part-time?
Full-time. So I jumped in with both feet. I had partners. I've had teams. Like we had LLCs, etc.
You're from Dallas originally?
I'm actually born and raised in Fort Worth. True Texans.
True Texan.
Yeah, born and raised in Fort Worth. Went to school in Lubbock, Texas. Went to school in Abilene.
Okay.
Got married. Moved to Dallas.
Okay.
And that's where I've been ever since.
Okay. And how did your real estate journey start?
Oh, as soon as I graduated, I got a master's degree. As soon as I graduated, student loans started calling me.
Yeah.
Say, you owe us money.
Where did you get your master's?
I got my master's at Abilene Christian University.
Okay.
Oh, yeah. And then all of a sudden, I was like, I need to get a job fast.
Yeah.
So I jumped into real estate and never looked back. That was it. That was it for me. There was money coming in. There were deals being done. And this was after 2008. So like just after 2008. After
Perfect
everything.
timing to acquire.
Perfect timing.
Did you keep them as rentals?
So I kept them for rentals. I've done the wholesaling method. You name it. I've kind of had my hands on a little bit of everything.
Okay.
Jack of all trades.
Which one was your favorite?
Honestly, at that time.
It was a niche that you concentrated more in?
So it was basically residential. And that's actually what I've been doing forever, is residential. I really like the income level from short terms, but I like the consistency of long-term rentals.
Yes.
For sure. But I never got into multifamily until years later.
Okay, got it. And then what brought you to cost seg?
So I basically, every year, I was paying taxes on the income that I made. The more income you made, the more taxes you paid. I thought that was the normal thing. And then in 2017, the Trump administration was in office, and they did this, the Tax Cuts and Jobs Act, which gave you bonus depreciation. And I guess we can talk about that in a little bit.
Of course, yeah.
But that opened my eyes, and I jumped in it. And I started with my company I'm with right now, Madison Specs. And I've never looked back.
Great.
It's phenomenal. Like the idea that there are tax incentives out there for real estate owners and investors, from top to bottom, even the little guy. That's the way to flow right there. And
that's something that as I told you, I've lived in the U.S. in different times of my life, but recently only for the past 3 years and a half, and that's when I started learning about this. And I get to compare how taxes work in different countries, and it's impressive how the U.S. government actually incentivizes you, and they're pretty smart, actually, because it moves the economy. So that incentive is to continue moving the money and to continue investing, and that gives growth to our region. So
That's
it's
the key.
that I just think it's brilliant, and I love it.
Absolutely. I mean, you can even look at it in the history of how our economy goes up and down. It's kind of surrounding real estate in all forms.
Mm-hmm.
Yes.
So,
and people saying, I mean, I don't want to get into politics here also because I'm not that knowledgeable. I mean, a little bit,
we
but
could talk for days on politics.
but about, people say, I am not paying taxes. And yes, you don't pay taxes because you are reinvesting your money and you're creating wealth and creating development, etc. Okay, so not to go into politics. Let's go into cost segregation. So can you explain to our audience what does cost segregation mean, please?
Yeah, absolutely. So before cost segregation, there's depreciation.
You're right.
So depreciation is essentially tax law that you buy a property. I can use flat numbers. Let's buy a big commercial property for $1 million. All right, you take land out of the equation. Land is non-depreciable. A tornado came and knocked a building down. What's left?
The land.
The land, yeah.
Same.
So when you take the land value out, you're left with a depreciable basis. That basis is what you're getting in tax loss depreciation over the course of 30 to 40 years. All right. Regular straight line depreciation, you just take that basis, divide it by 27.5. That's what you get. So the best, most easiest way to explain it, to visualize it, is to use a pizza. So essentially, if you get a cheese pizza like my kids love, they don't want any toppings on it. They don't even want sauce on it, but we'll keep the sauce on. You got the crust, the sauce, the cheese. All right, that is, if you cut that into 30 even pieces, and you can take one per year, that's how much you're going to get into straight line depreciation. Now, what cost segregation does, it takes all the toppings. You can put pepperonis, sausage, peppers, you name it, whatever's on it. And you can even put it inside of a box. That box can be considered your, outside of the property, landscaping, fencing, driveways, all that stuff. All the toppings represent the tangible assets, like your lighting, your flooring, cabinetry, everything like that. So by having those on there, you can take them off and separate them. They're a shorter life expectancy.
And a super basic concept about depreciation is that it's an expense. So if you have, it's an expense on books, but you're actually still using. Now, it's like a computer. You buy a computer for your office and you depreciate it over time. And in your books, it's like basic accounting. It's an expense on your book, but it's still giving you a useful life, right?
Absolutely.
It's the same,
Everything that based on that one purchase price has a life expectancy or a replacement cost.
Which here is 27.5.
27.5.
So just to give you an example, I have a rental property.
Perfect.
Why would I opt? Do you do two questions? Sorry. One is, do you have to do either or? Of course, you cannot double dip, right? You do depreciation every year, or you do cost segregation and sum it up, divide it by 27.5.
Right. So you actually have three options available to you. You have to do one. If you don't, the only reason you don't do one is because the property is losing massive amounts of money from the very beginning. So that's one key. So because it's losing money,
you don't need more.
You don't need more
You don't
losses.
need expenses.
Exactly.
You have enough losses with it as it is.
Exactly.
Okay.
So the idea is, like, you can do depreciation straight line, like I was explaining. Cost segregation separates everything out into their correct life expectancy buckets, buckets of losses.
So if I have my CPA, so he would do just a normal straight line depreciation, and each year it would put in the expenses, whatever that number, divided by
27.5.
That's right. Exactly.
What is the third option?
No, but the second is, you said the bonus. No.
Cost segregation.
Cost segregation. So
segregation.
then, in that second case, I hire someone like you. You come in and you go and look at every piece of, like, floor, tile,
everything,
railing,
from the peepholes on the doors to the signs for handicap parking. I mean, it could be just about anything you think of that's not structural. Foundation, windows, walls, roof. What makes the building a structure? that stays straight line depreciation. You can't move it around.
And the delivery from that thing that I hired you for that is you deliver like a book or something to my accountant so they can take that and input more expense.
Oh, for sure.
In my P&L.
CPAs and accountants love us because we're simply taking 80, 90, 100 pages worth of numbers and line items and replacement costs, everything construction related, and giving it to them on a silver platter. So they can just plug into your tax returns and move on to the next thing.
But would that replace the line what is depreciation? In other words, like you gave them on one side you gave them a cake, and the other side you gave them every single ingredient in the cake. So one replaces the other one. So if you do cost segregation, then you put it into it. It's normally going to be more. It's going to help me do more.
Oh, for sure.
Okay.
So let's say, for instance, right now you have $20,000 of depreciation. When we do cost segregation, it's going to double or triple. Let's just say it triples the amount of depreciation. So instead of $20,000 depreciation loss, it will now say $60,000 depreciation loss. It's not going to, on your depreciation schedule on your tax return, it's not going to be a ton of lines. It's going to be one number. The ton of lines is your backup.
Gotcha.
Part of those 60 is the 20 that you already had.
Exactly.
Yeah, so you cannot double dip, but it's part of that. So he studied.
You add up.
You
to
add up.
whatever you base depreciation.
That's correct.
And okay, so that's what you do. And then the third one, which is the one we love.
The third one is what I love too. As a real estate investor, it's phenomenal. It's bonus depreciation. So bonus depreciation started in 2017. And
quite new.
Yeah, very new. And apparently it's, that's the only way to go in residential properties nowadays. The idea is it's going to do the same thing as cost segregation, but instead of taking, separating all the assets out, they're going to push 5 and 15, anything under a 20-year life. So that's your interior tangible assets, your exterior land improvements, and they're going to move it into year 1. Push all of it into year 1. That 10x's the amount of depreciation, like as normal, into the first year. And with that amount of losses, unless it's crazy, you can use all of them. You can roll them over to the next year, year over year over year. You just keep rolling them over.
So basically, bonus depreciation is cost segregation on steroids.
That's right. 100%.
The number, let's continue with that example about the 60K loss.
Sure.
We were on that example, right? We said that the loss, remember the example that you said that I have a property and on the depreciation line, it says 20K.
Okay.
But now we did the cost segregation, so now it's 60K.
Now you're getting 60K.
No, it's 60K.
But those 60K is going to go on the 27 years or no?
Yeah, so it's pushed up front. And then it's kind of roll over. It goes down after that. So year 1, you can get 60K instead of 20, right? Let's say you only need to use 20. The 40 that's left over, 40 difference, is rolled over to next tax year, and you get a little tiny bit added, like let's say a $1,000 or $2,000 added on top of that. So now you're starting next year's tax liabilities with a $42,000 tax loss.
Okay.
So it's just allowing you to, have the time value of money. You're going to be able to take all that depreciation for the next 30 years.
But that's what we're talking about, the second thing, the bonus, no, not the bonus, the
cost segregation.
Cost
But
segregation,
to the same example, you add the bonus, instead of 60 the first year.
It could be 120.
It depends,
it
because it will be just adding up that 27 and a half years all in once.
So there are, the one downside to it is that the structural component, the 27 and a half year component, that has to stay consistent, years 1 through 27 and a half. But everything else, all the 5-year, 15-year, which is, again, tangible assets and exterior land improvements, those get to be pushed up to year 1.
If you need it to be pushed
If you need it. Yeah. If you don't, cost segregation is great. And if you don't need cost segregation, then stick with straight line depreciation. This whole thing is a tax strategy. So it's also based on, what your tax implications are. I mean, some people don't need that amount of losses. Some people,
So let's put examples. Let's put like a very basic example. Why would someone don't need this? Like, you wouldn't recommend for everyone, like as a rule, every real estate investor that has 1 or 2 single-family homes do a cost seg. Would you recommend that or no?
So it's if you
Or
are
when would
planning
you
on
don't need it?
yeah, when you don't need it, that's a smaller.
I know. I just need to completely fully understand the concept.
If you are buying a property and selling it in the same year, you don't need cost segregation.
Yeah, but
you don't even need depreciation in that case.
Yeah, but that's very unlikely. But yes,
Because something important to mention is that when you sell that property, the depreciation come back or the cost
I want
segregation.
to talk about that a little bit later.
Yes, because that was a surprise for me in a bad way. but
I want to talk about that once we completely fully understand the concept and how it applies. Okay, so that's one chance you don't need it. If you are having losses with other properties, you wouldn't need it either.
Yeah, I mean it's a whole calculation play. If you have enough losses with all your other properties to offset that one for maybe this year and next year, you don't do cost seg.
Okay.
Absolutely. So, and I'm very upfront about it. If it doesn't make sense for you, don't do it.
Okay.
But also there's multiple other reasons. You could have write-offs, deductions, expenses, everything that's added on top of regular straight line depreciation, and that is a massive amount of losses, then you don't have to do cost segregation.
But shouldn't you always do it anyways, because you don't know what the future will bring, and you will have, like, if you have a portfolio of investments, the beauty about this is that correct me if I'm wrong, my understanding is that all these losses at the end of the day can help offset other income from other investments. So,
and that's where we get really into the weeds.
Yeah. So then I would say, yes, always do it. If you plan to continue investing in the long term, and we think that you're investing because you want to, you're going to make more money, so you're going to have more income. So at the end of the day, you're eventually going to need it. No?
Absolutely. If you're in real estate and you want to stay in real estate, stockpiling losses is the way to go. Okay. That's how I like to look at it, because you never know when a capital event's going to happen.
Never know.
You never know when you're going to need them for a rainy day, because I use them for my own W-2. Like, I can use my losses in real estate investing to offset that.
Professional.
Yes.
Absolutely.
But because you have a real estate professional status.
Correct.
Let's not mix up. Okay. Sorry, but I want to. So it's such a hot topic.
Taxes can be exciting.
Yes.
Yes.
Okay. So there's a time frame when I buy a property and I want to conduct a cost seg study in order to use a cost seg and maybe do the bonus, because we haven't talked fully about the bonus appreciation, but there's a time. I cannot do it any year, right? If I already have an investment portfolio, can I go and run a cost seg on the properties even though I bought them long time ago, or
you
or
can?
No? Yes?
You absolutely can.
Oh.
So the only downside is not downside. I always say downsides. I don't mean to say that. Yeah. So the only concept is if you are doing, this is the first time you guys have heard about cost segregation and you've owned properties for years, then you can still do cost seg now and apply it to this next tax season. So let's say 2024 taxes. You can, if you've owned properties since 2015, I'm just throwing a random one out there. Or no, even better, let's do 2018. We can do cost seg now on those properties. Then you can still get 100% bonus, which we'll talk about more in detail, and apply it to your 2024 taxes and essentially wipe it clean legally.
Gotcha.
Okay. So bonus appreciation. So there's the law. Tell us a bit about. Let's go more in depth in that. So as you said, it's cost seg in steroids, because you could actually take the whole losses of the 27 years to 1 year or as needed, right?
Correct. So bonus depreciation allows any asset class under a 20-year life. Under a 20-year life.
Under 20 years.
Yes. So anything over a 20-year life, like your foundation, windows, wall, the structure of the building, that stays the same, years 1 through 27.5, which is actually kind of good, because that allows you to be able to always get depreciation no matter what every year.
Even if you do bonus.
Yeah, even if it's a little bit. So anything under a 20-year life, you're able to push forward. Now, the Trump administration did make phase-out changes in bonus depreciation, meaning from 2017, actually September 2017, until December 31st, 2022, you could take all of it up front.
100%.
100% bonus depreciation.
In our fund, we got a lot of investors that were motivating to invest before that year ended, so they could get that benefit.
Absolutely.
And then it started to go down by year.
For all of 2023, any property that was placed into service, you are only able to get a maximum of 80% bonus depreciation. Now, it didn't mean that it goes away. It just means that the remaining 20% is rolled in over the next few years. So you're always going to get it. You're just taking the big part up front. Yes.
Okay.
And now we're, we're just past 2024. 2024, you were only able to take a max of 60%. Now in 2025, you can only take a max of 40% year one. But
there's a law. Now, there's a law that last year there was a law that went into the Congress that wanted to go back to 100%, and it didn't pass. Because on my fund, we were waiting, we did K1s, and then we didn't do K1s because we wanted to wait if the law passed.
That's right.
But then it didn't pass. But rumors are that it's going to come back.
Absolutely.
What can you tell
even
us?
in the news this morning, there was talks about administration being put into place for the inauguration next week. That's one of the first topics they're going to do is restart the 100% bonus. Now, the key is how long and when does it start? Because they could start it for 2025 or they could be retroactive to 2024, in which case every property that's changed hands in all of 2024 will go from 60% bonus to 100% bonus.
But that would require to file an amendment on the taxes for that year.
Possibly, but taxes haven't been filed for 2024 yet.
Okay,
so it's very possible that what that means is that every cost seg report that I've done in 2024 is a simple quick change. We've already been ready to go for it. Quick change and then resent to all CPAs and clients and owners, everybody.
And they're getting additional
And they're
losses.
getting a ton of losses.
Okay.
And sometimes it's worth it to pay that. I mean, actually, many of the times, or most of the time, it's worth to pay that or the hassle of doing the amendment to get the losses.
Yeah, and now that's the other side of it. Going back to, this is the first time you've heard of cost seg, and you want me to look at a property that you bought years ago. We can still do cost seg and apply it to this, this very next tax year. And you don't have to amend any previous tax returns. No, not at all.
Because it hasn't been filed.
No, even if they have been filed. No.
No, I got you. Yeah. You can just add it to it. We don't have to move the one because they are the ones who changing it for this year.
Exactly.
So you are in
Exactly. So the only difference between a new buy and a property you've had for years is that we take whatever depreciation, straight line depreciation you've taken over the last few years, and we just take that off the top. Then you get the next 20 plus years pushed forward.
Okay.
Okay.
I have a question I know we were very technical on the types and everything, but just for people out there who are listening to us, who just bought their second or their third rental property, is something they can do where they can analyze several at a time to see which one, let's say one is losing money, but the other one is making money and they want to offset one to the other one. So maybe it makes more sense on one to do it and not the other. So I'm trying to see how a portfolio will help a real estate investor to do something like that.
Absolutely. So if you have multiple properties, all the income that you're generating and losses, regardless of your status as either a real estate professional or just a passive investor, they are generating passive income, passive losses. Now, with the cost segregation, we can do it on one or all properties, whatever works for you on your tax implications. And then you can take those losses because they're the same losses for all the properties and apply them to all the properties. That's the key. A bulk portfolio, you can take bulk losses and apply them across the board.
Okay.
And for this example that Gabby mentioned about someone who's just starting that has one or two properties, would you recommend them to do the cost seg?
I recommend they look into it for sure. One of the key pieces on this, and this is with me and anybody else that does cost seg, always get free estimates because it's a lot easier to determine what your tax strategy is if you have numbers in front of you. So if it's somebody that has one or two properties, this is their first time, if the property itself is making money hand over fist,
Yes.
then cost seg is the only way to
But
go
that's
for it.
not the case right
No.
now, especially for the people that have been buying this past year,
Oh, sure.
these past 2 years. Maybe not, but in the future, since there's not a time limit, they need to know about this, and they could definitely, like in 2 or 3 more years, when they have a bigger
Yes.
portfolio and the properties are hopefully cash flowing more, they could go back and have the cost seg done on their properties and apply it to them.
You can absolutely. What I would basically say for somebody in that that situation is, if your property you are planning on, let's even go back a little bit further. If that property is making money, but your losses right now can offset it, if you're not planning on selling it within the next couple of years, then I recommend doing cost seg, because eventually that property is going to make more money than the losses you currently have, and you're going to have to pay income tax on it. And we hate paying income tax.
Yes.
Okay.
Yeah.
Now, can we move to the part when we sell?
Yes.
We
That's what
sell
I'm-
the property, and then let's say we deducted in the total of the years that we had that property with us. Let's say we deducted $100,000, either of those 3 options that we have.
Sure.
Is going to be, when we sell, that $100,000 is going to be counted as income, or like we getting that money back,
Right.
type of thing.
Right. It's called depreciation recapture.
Okay.
So depreciation recapture, a lot of people ask me, so what's the downside? This all sounds too good to be true. What's the downside? Well, IRS figured that out too.
Yeah.
So they simply said, look, when all the depreciation you're taking, you're essentially lowering your overall basis. When you go to sell the property, your gains is going to be based on the basis and the sale. So your calculated the capital gains will be higher.
Correct.
Okay, can you
Yeah.
repeat that again?
Sure. When you buy and sell a property, you're buying it whatever the basis is. That's minus depreciation and all that. And your sale, that's how you calculate the gain. When you take
Capital
we're
gain
English.
part.
Sí, o sea, el precio que compraste
Sure.
la propiedad,
Ajá.
and then it's your basis, ¿no? Entonces,
Sí.
that you're going to sell it, so there's a gain there.
That's right. There's a gain regardless.
Yeah,
Exactly.
exactly.
Yeah. So what depreciation, cost segregation bonus, that's simply taking those losses and lowering your basis overall. So you're getting losses up front to use now. So when you sell the property, your basis is going to be much lower. So your
let's
gain's
say,
going to be bigger.
Let's say
yes,
my
yes.
basis was 200,000. I bought it at 200,000, and then I sell it at 500. Regular will be, my capital gains will be on 300, but because I have to deduct that 100,000, then my basis go down to 100. So my capital gain is based on the 400.
Yes, but there's always a but in this. A lot of people ask me, so that means I have to pay it all back at the end. No, you pay a maximum of 25% back. That's the cap, 25%. The key is it's based on your ordinary income tax rates. So if you're above, let's say you're in the 43% tax bracket, then you pay 25%, not 43, 25. Now, if let's say I have enough losses and everything to offset my taxes to put me in the 16% tax bracket, then I pay 16%, not 25.
So anyways, it's good because if you're doing this all the time, you're going to keep on staying in a low tax bracket.
That's right.
So when you sell one of the properties and you have to repay that bonus depreciation or that depreciation that you didn't pay, you're gonna give it back. It's está topada, right? It's capped. It's capped
It's capped.
on 25%, depending on the tax bracket that you are. So it's still
Absolutely.
convenient.
Or even better, you can do a 1031 exchange.
Correct. I was literally just about to go there.
And if you don't remember, pueden ir we have an episode on 1031 exchange in Spanish. De nuestros primeros episodios que hablamos del intercambio 1031 para que entiendan lo que es otro súper beneficio fiscal.
Oh, it's very nice. I've done it a few times myself. It is pretty fantastic. But also there's so many loopholes in there as well. And I love using the term loopholes because it basically is implying that it's not illegal, it's legal, and it's in the IRS code book for everything. It's just a matter of finding it.
Correct.
So one key piece, and this is I can use a personal example on this. So, when I go to sell a property, after I've done cost seg on it, I'm going to have a massive, gain on it that I'm going to have to pay back on taxes. Well, thank goodness that I also had 2 or 3 other properties that I'm not selling that I've got massive losses from the bonus depreciation, now I can actually use those losses to offset these gains and pay nothing on the taxes and no 1031 exchange.
And you don't have to do that regain, that
No, because of my losses offset my gains. However, you have to be an active real estate professional.
To do that, the example that you said, you have to be an active real estate professional.
Exactly.
Okay. So in that case, how do you say that it was called when you regain? La palabra?
Recapture.
Recapture.
So in that case, you won't recapture that because you have other portfolios.
That's
You have other
I have
properties
other
in your
losses.
portfolio. So you have other losses. So, okay.
So for you becomes an active gain against an active loss.
Correct. Now, it's not because I'm actually in real estate. It's not because I do cost segregation.
Correct. Yeah.
In order to become an active real estate professional or rep, REP, you have to have 2 qualifications. And that's 750 hours a year involving real estate, whether it's closing, transactions, research, education, whatever.
Even research and education?
Absolutely. Matter of fact, this right here is 1 hour.
I know. Actually, because it's funny because we have also talked about this status. We have an episode in Spanish. Let's go with it again.
With Ana Klein. No?
With Ana Klein, so look for it. But because not all the CPAs know this.
I know.
And I hate it because I had one CPA that told me, no, you're not doing, you're not you cannot be a real estate professional. I'm like, how come? Like I do real estate all the time. I don't have any other job. And we'll talk about that because I know you have comments on that. And he said that this wasn't that I had to be an active landlord with la. But then my new CPA, he's like, of course you can. Like all this talking and discussing real estate
absolutely
gives you that real estate. I mean, you are totally a real estate professional. So again, someone has to can show that they dedicate 750 hours a year to real estate, and it could be any type.
And surprisingly, the other side of it is 50% or more of your business is related to real estate. And the funny thing is, the IRS actually is more scrutinized on the hours than they are the business. Really? Yeah, because now it's not about income. It's not about how much money you make in real estate. The IRS knows, or they should know, how much you make from real estate. It's all about the time you spend in it. And that could bring up a massive amount of different loopholes as well that I could talk about. And I'll give you one in just a second. But, the key to that is by qualifying, your passive income, passive losses now become active. They're switched over, which means you can apply them to your real estate income. You can apply it to stock income. You can apply it to
W-2 income.
W-2. If I had a garage sale and I actually told the IRS how much I made from it, I can apply losses to those gains. It could be across the board.
Yeah, but with Lala was mentioning about the full-time job versus a person who is a full-time, let's say a doctor. It's going to be really hard for a doctor to qualify for a real estate professional status. I mean, they have to prove. They have to really be working on it. But the wife, significant other, or whoever they file taxes with, they can do it.
That's right.
Yes. I know who you're thinking about.
Yes, exactly.
So what I was going to say is that her husband, can do it, even though he's employed, even though he has a W-2. We're thinking about certain couple that we know, because we talk about this off camera a lot. So there's a couple that we know, and this person is a doctor and or a lawyer or whatever. Those type of
absolutely not real estate, and not
W-2, another W-2. Those that depend on your time, like a doctor, a lawyer that you have. Yeah,
it's fully in the office.
So his her husband. It also has a W-2. Okay. Can someone that have a W-2 be a real estate professional too?
It's very possible, yes. So it's about the hours calculated. Now, if that W-2 person works 60 hours a week and they still claim they can, do 750 hours a year involving real estate, that means they sleep 2 hours a day.
Yeah, that's impossible.
It has to make
that's
sense,
not possible. Yes, it has to make sense. But I always recommend calendars. There's also apps out there. I think there's, what's another one? Toggle app. There's a lot of people use that for single families and short-term rentals. It calculates the hours spent doing things, whether it's researching, whether it's underwriting, whether it's maintenance, management, whatever. Just calculates your hours. I mean, it's a hassle, and a lot of people don't like doing that, but trust me, it's worth having it as a backup.
It
But
it can be also like having another job, because the amount of losses you're going to be able to deduct sometimes can
Worth
be in
it.
the thousands. It's going to save you thousands of dollars.
Absolutely.
Because normally, well, in Texas, people file jointly. So that way, and this is something I tell another couple that I know, that I'm always like telling them buy real estate, and they're like, no, the interest rates are so high, and I'm like, it's
And
someone
that
really
doesn't
close to me, and I'm like,
Yeah, those
please,
rules
if
don't
I were
apply
you.
to me.
I get the same. I get the same thing.
we are both me and my husband, we are both self-employed, so we cannot play this loophole. But I know a lot of people that they have like one W-2 and the other one is not. I mean, she works a lot, she takes care of the kids, whatever, but she's not actively employed. She doesn't have W-2. And they have the resources and everything and the credit to invest in real estate. And he's paying so much in taxes. And I'm like, come on, buy a house.
Well, I mean, but there's also other things out there as well. I mean, let's say, have you guys heard of the short-term rental loophole?
Yes.
Yes.
We've heard of it.
Oh, yeah.
Tell us about it.
That's one of my favorites. So if you buy a short-term rental, all right, and you actively participate in whether it's maintenance or managing, bill collecting, whatever, or even cleaning it after somebody leaves every time, then technically it falls in this loophole where you can claim all the losses active, no matter your status, no matter if you're a real estate professional, passive investor, doctor, lawyer, whatever.
Yes.
You can take all those losses and attribute them towards your active income.
And you know what? I was mentioning that to a friend of mine who can qualify for it. And I saying, take advantage of it, because you don't know when the IRS is going to catch up. Because
I agree.
this short-term rental, it was all that loophole was found with all this craziness that everybody has short-term rentals and everybody want an Airbnb. And now people are finding out of this loophole. So, and like in everything, some people are taking advantage of it. So whenever the IRS catch up with it, it's going to change the law. So take advantage right now. Absolutely. And same thing with the bonus appreciation. I mean, with depreciation, anything that is happening right now, we need to take advantage of it before it changes.
So again, I'm going to say it in Spanish. So if you have a W-2, if you have a job, si tienes un trabajo, and you wanna pay less taxes on the taxes that are taken from the company that pays you from your W-2, but you own a short-term rental, if you dedicate X amount, if you do anything, but there has to be like how do you prove your...
It's really just a matter of 50% or more of your time involving the property. Now, if I was to say, let's say, if I was to delegate everything to an outside third-party company, more than likely I'm not I'm not an active participant.
Gotcha.
But it should be you. It doesn't have to be your wife necessarily or your
doesn't
partner.
Have to be your wife or
it
nothing.
Be
Absolutely.
yourself. But how much time? If I work 40 hours a week, how much time would I have to dedicate to that in order to offset my W-2 taxes with that short-term rental?
Think of it like this: if I owned a short-term rental property. And I mowed the grass every day or every week.
Yeah.
Right. And then every time somebody would rent it, when they moved out, I would do the laundry, cleaning all the beds and everything. I can just by doing that only, then I can collect all the losses and apply it to whatever income I want.
Even if the hours are not 20 hours a week?
Even if it's not 20 hours a week, because I'm spending more time than other people that's dedicated to it. Does that make sense?
So it's you spending more time on your property. It's not you spending more time than your actual W-2 job.
Exactly.
No.
Oh, no.
Yeah,
Yes.
No. Yeah.
It's actively participating in the property.
So that's why he was saying if you have a property management, more than likely that property management is spending more time in your property than you are. But if you can prove that you are the one who's spending 50% or more.
I can be like the handyman, the mowing,
Absolutely.
it could be like a great hobby. That gives you money and makes you pay less taxes.
That's
Love
right.
it. Buenísimo.
Yeah.
Great. Tell us about another loophole.
Another loophole. How about multifamily syndication?
Mm-hmm.
Okay, so
Which is what I
multifamily
do.
syndication. A lot of people are like, I just want to put my money in and get the income back.
Mm-hmm.
So what they don't realize is when you do that, you're investing in an entity.
Mm-hmm.
You're not buying the property. You're buying an entity that's buying the property.
Mm-hmm.
Now, through that entity, it's going to generate tons of income and losses.
Mm-hmm.
And the key there is a loophole where you can, when you invest in it, based on the calculated lending rates, calculated ownership percentage, and the GP, general partners side of it, that you can actually double your losses by investing in it through a different shelter. There's that gets a little bit more complicated. Now that I'm saying it.
This is looking at from the investor, the limited partner point of view.
Mhm.
Okay.
Yes. So when you're like for instance, if you invest $100,000,
In an LLC that's buying an apartment building.
correct. As long as the split percentage is correct, so meaning that if you do a GP-LP split,
And I get 80-20.
yes, 80-20, but that's on the income. As long as it on the passive level, on the depreciation only, as long as that is 100% to the passive investors, meaning if you invest, you get back losses. It's not, there's no split on that side of it.
No.
Then they can essentially get an additional 20 to 40% of losses back year one. Yeah, that's just a calculation.
But I've never heard of that. Like, how can you? I mean, I get tons of losses in my taxes, tons because of all my investments in multifamily, but then can I increase those?
You
Even
can.
more?
Oh yeah.
How come? What's that? I'm
this
intrigued.
is where it gets so complicated because you now are involving your PPM. Like when you're signing off on a new property and you're getting investors
That's basically like that contract.
Yep, that's a contract. Absolutely. Before you invest in the property, by changing the percentages on the PPM, then every investor that puts money into it will get an additional 20-30% based on the LPGP, the passive investor versus general partner on depreciation only, not income, just the losses.
Okay.
So by doing that, the reason I'm saying that is because, a lot of times towards the end of the year, high net worth individuals are looking for tax losses. And so they run into these syndications that are doing 100% to their passive investors. And they're putting in 100,000, they're getting back 90,000+ in losses for that year. So that's one key piece.
And, I was really surprised to see that even experienced wealth advisors don't know that you could offset these losses with gains coming in from investments in like structured notes, ETFs, like all these financial figures. You could offset that.
Oh, absolutely.
But I was like, I mean, why isn't everyone doing this or talking about this?
Well, again, I didn't enjoy talking about taxes 10 years ago. I thought taxes were, if you didn't understand
we've lost half of our audience by now.
Yeah.
Probably. But
if you're a geek like me, you'll be there. Like you want to ask more questions.
Absolutely. So it's just kind of a wide known thing that everybody thinks, oh, I have to pay taxes. I have to pay tax. Now,
wait, let me do something. If you have a question right now that you're thinking that we haven't asked, please put it in the comments, and I promise you that we'll email you back with your email. We'll email you back.
Oh, for sure.
With the answer. Okay, continue.
No, absolutely. So, I mean, but the key is, again, the IRS. I don't like the IRS because I have to pay taxes sometimes. But they put so many different codes and factions and everything into the IRS guidebooks. There's actually an entire book called the Cost Segregation Audit Techniques Guide.
By whom?
It's this thick, by the IRS.
Wow.
They didn't want to put authors on it.
Okay.
But it's a good read. I mean, if you put it on your nightstand, you read it at night, you're out like that.
I read, but I didn't read that. Will Wright. It's his last name, right?
Wheelwright. Oh, Tom Wheelwright.
Tom Wheelwright. Yeah. He's written a couple of books.
Real estate CPA. Yeah. Absolutely. He knows what he's talking about.
Yeah, I know. It's really good. I have it on my nightstand. I just need to finish it.
No, it's a fascinating topic. But at the end of the day, you need to be learning, researching,
Correct.
asking your CPA. It's pretty much like a doctor,
Even if you ask to your CPA, many CPAs don't know this. Many wealth advisors don't know this, or they think you're doing something wrong that you don't want to do. And
Correct. So, I mean, I love CPAs. I work with hundreds. As a matter of fact, you can't do what we do without your CPA being able to work it out. But if in two different ways, if you have your CPA doing the depreciation, it's throwing darts at a dartboard. I mean, a lot of it's guessing without like actual concrete data, like what we do with engineering-based studies. And there's also, I've actually give continuing education credits to CPAs all around the country trying to teach them all this concept. And a lot of them, they just wasn't being taught. And bonus depreciation didn't come out until 2017.
Exactly. So it's something new.
So something new to learn.
Mm-hmm.
So
Yeah.
they don't do
And
classes.
probably when they change the law here shortly, if it happens, it's going to be something else that they have to learn,
That's right.
So just like if like the cherry on top of this, so how much would a cost seg study cost? I mean, so Brian's doing the cost seg study for the property that we recently acquired,
Sure.
48 Lane here in Round Rock, commercial. So, but how much like for a normal, like a standard, an average
Single family home.
home?
Oh yeah, it's kind of based on size. Now it's not based on the percentage you find. Matter of fact, if you guys are going out looking for cost segregation for your property, never ever ever go with a company that's charging based on percentage found. That's a big red flag. By doing that, they're gonna big time bump up the numbers.
Okay.
You're gonna pay a ton, and they might not be there just in case you get audited.
Gotcha.
So it ranges. I've seen studies go for hundreds of dollars. I've seen studies, massive, like New York City style studies, go for 5-6 figures worth.
Yeah.
So it's based on size. It's not really based on location.
But just ballpark, single family home in Austin,
Texas.
that's $500K.
Sure.
Built in because the year counts, right? Or no?
No, not the year.
It's the
Yeah,
same.
just
It
built.
doesn't matter.
Yeah, it doesn't matter.
Yeah,
Okay.
2,000 square foot, 2,500 square foot.
2,500 square foot.
Absolutely. If it's a single family or even a short-term rental, residential single property, you're looking at roughly about 3,000 or more.
Okay.
But I would say it wouldn't be more than 4,000. So it's in
Okay.
that range.
But
Yeah.
it pays
Yeah.
off.
It
Now
does
the-
pay
Yeah.
off, yeah.
But that's the key. It also, let's say, for instance, that $500K property, let's say land is 50% worth. That leaves you $250,000 basis. Now, if I was only able to find $50,000 worth of losses that you can accelerate, I'd say don't do it.
Okay.
With that small amount, then I would stay the course what you're doing right now. And if you sell it, great. If not, you want to keep it, just keep rolling those write-offs, deductions, expense write-offs, all that stuff, and add those all together. The idea is, like, I'm not trying to just be a sales guy. You want to make sure that it actually puts
Makes
a dent
sense.
in your tax returns.
Interesting.
So, and that's why we do estimates. That's the key.
I know, Brian. I really appreciate you driving all the way from Dallas
Sure.
to our studio here in Austin. Thanks for sharing this super valuable information with our audience. And remember, if you have questions, si tienen alguna pregunta o quieren algo específico, just write it on your comments and we'll be happy to share it with you.
And we're going to leave you information in the description so they can contact you for a free estimate.
So, pues, muchas gracias. Yo soy Lala Elizondo.
Y yo soy Gaby Proctor.
Y esto fue
Real Estate Talks.
Si llegaste hasta aquí es porque te gustó la información y estás interesado en invertir en real estate en Estados Unidos.
Para esto hemos creado un entrenamiento que te va a simplificar este camino, ya sea que seas un inversionista por primera vez o que seas un inversionista sofisticado.
En la descripción de este episodio está la liga que te llevará a este entrenamiento.
O bien búscanos en Instagram como @invierte con Lala y Gaby y comenta con la palabra invertir en cualquiera de nuestras publicaciones y así te mandamos la liga a este entrenamiento.
Muchísimas gracias por habernos escuchado. Nos vemos en el siguiente.
Escucha un episodio nuevo de Real Estate Talks cada semana.
En tu plataforma favorita para escuchar podcasts.
Ponte en contacto con nosotros en lalaygaby.com.